Here are some elements of investing we wish we'd always known. In financial investment, experience may well be the best teacher, but the tuition is very high. Our objective is to provide you with some basic principles for a lifetime of financial success in saving and investing. That's why we present one of the most important lessons in this easy-to-watch, jargon-free little video. Diz and me gonna win 50 games. We will land the man on the moon and return him safely in this decade. I shall return. Each of these major plans met one great test: clarity. If your plan is clear, it will be easier for you to stay on plan. The other test of a good plan is that it works. It works for you because it's doable. It works in the market because it's realistic. It works because it helps you achieve your objectives. Great coaches all agree with a simple summary of how to succeed in athletics. Plan your play and play your plan. That's why you'll want to develop a clear and simple financial plan and stay the course. Here we present a remarkably simple plan for investing that uses low-cost index funds as your primary investment vehicles. Index funds simply buy and hold the stocks or bonds in all or part of the market. By buying a share in a total market index fund, you acquire an ownership share in all the major businesses in the economy. Index funds eliminate the anxiety and expense of trying to predict which individual stocks, bonds, or mutual funds will beat the market. This simple investment strategy, indexing, has outperformed all but a handful of the thousands of equity and bond funds that are sold to the public. But you wouldn't know this when Wall Street throws everything but the kitchen sink at you to convince you otherwise. This is the plan we use ourselves for our retirement funds, and this is the plan we urge you to follow too. Nobody knows more than the market. It is difficult for most investors to believe that the stock market is actually smarter or better informed than they are. Most financial professionals still do not accept the premise, perhaps because they earn lucrative fees and believe they can pick and choose the best stocks and beat the market. As the author Upton Sinclair observed a century ago, it is difficult to get a man to understand something when his salary depends upon his not understanding it. The cold truth is that our financial markets, while prone to occasional excesses of either optimism or pessimism, are actually smarter than almost all individuals. Almost no investor consistently outperforms the market, either by predicting its movements or by selecting particular stocks. Why is it that you can't hear some favorable piece of news on the radio or TV and read it on the internet and use that information to make a favorable trade? Because an army of profit-seeking, full-time professionals will have likely already pounced on the news to drive the stock price up before you have a chance to act. That's why the most important pieces of news, such as takeover offers, are announced when the market is closed. By the time trading opens the next day, prices already reflect the offer. You can be sure that whatever news you hear has already been reflected in stock prices. Something that everyone knows is not worth knowing. Jason Zweig, the personal financial columnist for the Wall Street Journal, describes the situation as follows. I'm often accused of disempowering people because I refuse to give any credence to anyone's hope of beating the market. The knowledge that I don't need to know anything is an incredibly profound form of knowledge. Personally, I think it's the ultimate form of empowerment. If you can plug your ears to every attempt by anyone to predict what the markets will do, you will outperform nearly every other investor alive over the long run. Only the mantra of "I don't know and I don't care" will get you there. This doesn't mean that the overall market is always correctly priced. Stock markets often make major mistakes, and market prices tend to be far more volatile than the underlying conditions warrant. Internet and technology stocks got bid up to outlandish prices in early 2000, and some tech stocks subsequently declined by 90% or more. Housing prices advanced to bubble levels during the early 2000s. When the bubble popped in 2008 and 2009, it not only brought house prices down, it also destroyed the stocks of banks and other financial institutions around the world. But don't for a minute think that professional financial advice would have saved you from the financial tsunami. Professionally managed funds also loaded up with internet and bank stocks, even at the height of their respective bubbles, because that's where the action was, and managers wanted to participate and not get left out. And professionally managed funds tend to have their lowest cash positions at market tops and highest cash positions at market bottoms. Only after the fact do we all have 20/20 vision that the past mispricing was obvious. As the legendary investor Bernard Baruch once noted, only liars manage always to be out of the market during bad times and in during good times. Rex Sinkfeld of Dimensional Fund Advisors put it in a particularly brutal way. There are three classes of people who do not believe that markets work: the Cubans, the North Koreans, and active managers. The Index Fund Solution. We have believed for many years that investors will be much better off bowing to the wisdom of the market and investing in low-cost, broad-based index funds, which simply buy and hold all the stocks in the market as a whole. As more and more evidence accumulates, we have become more convinced than ever of the effectiveness of index funds. Over 10-year periods, broad stock market index funds have regularly outperformed 2/3 or more of the actively managed mutual funds. And the amount by which index funds trounce the typical mutual fund manager is staggeringly large. The following table compares the performance of active managers of broadly diversified mutual funds with the Standard & Poor's, or S&P 500 stock index of the largest corporations in the United States. Each decade, about 2/3 of the active managers must hang their heads in shame for being beaten by the popular stock market index. The percentage of actively managed mutual funds outperformed by the S&P 500 index was 61% for 1 year, 64% for 3 years, 62% over 5 years, 64% over 10 years, and 68% over 20 years. The superiority of indexing as an investment strategy is further demonstrated by comparing the percentage returns earned by the typical actively managed mutual fund with a mutual fund that simply invests in all 500 stocks included in the S&P 500 stock index. The next table shows that the index fund beat the average active fund by almost a full percentage point per year, year after year. The S&P 500 index fund earned 8.43%, whereas the average equity mutual fund earned 7.5%. The shortfall for the average equity mutual fund was 0.93%. Why does this happen? Are the highly paid professional managers incompetent? No, they certainly are not. Here's why investors as a total group cannot earn more than the market return. All the stocks that are outstanding need to be held by someone. Professional investors as a whole are responsible for about 90% of all stock market trading. While the ultimate holders may be individuals through their pension plans, 401k plans, or IRAs, professional managers as a group cannot beat the market because they are the market. Because the players in the market must, on average, earn the market return, and winners' winnings will equal losers' losses, investing is called a zero-sum game. If some investors are fortunate enough to own only the stocks that have done better than the overall market, then it must follow that some other investors must be holding the stocks that have done worse. We can't and don't live in Garrison Keillor's mythical Lake Wobegon, where everybody is above average. But why do professionals as a group do worse than the market? In fact, they do earn the market return before expenses. The average actively managed mutual fund charges about 1 percentage point of assets each year for managing the portfolio. It is the expenses charged by professional active managers that drag their return well below that of the market as a whole. Low-cost index funds charge only 1/10 as much for portfolio management. Index funds do not need to hire highly paid security analysts to travel around the world in a vain attempt to find undervalued securities. In addition, actively managed funds tend to turn over their portfolios about once a year. This trading incurs the costs of brokerage commissions, spreads between bid and asked prices, and market impact costs, the effect of big buy or sell orders on prices. Professional managers underperform the market as a whole by the amount of their management expenses and transaction costs. Those costs go into the pockets of the croupiers of the financial system, not into your retirement funds. That's why active managers do not beat the market, and why the market beats them.